Good morning and welcome to our 10th Annual Financial Executive Forum. This is the fourth event in our 2024 webinar series, and we really appreciate you all joining us this morning. My name is Grant Palmer, and I'm a partner with Cordia Resources by Cherry Bekaert, one of the sponsors of this series. As you'll see, we also have four other great local sponsors who I'll introduce shortly. And I want to thank first Jennifer Lewis and the AICPA's Business Learning Institute for the great Virginia Ethics program they put on for us last Thursday. Another informative and valuable presentation from Jennifer. So Jennifer, thank you again. Our sponsors have been excited to see the great response with over 600 people registered for this series. We know and understand how valuable these high quality and relevant training events are to financial professionals managing corporate accounting and financial functions. Once again, we're providing this series in a fully virtual format and running it in 2-hour sessions every Thursday morning over a 6-week period of time. We found that this format works best for our collective clients and friends. Today, we're joined by Ali Gregory, Gerald Escobar, Michael Cooper, and the team from Marsh McLennan, who will be presenting Managing Your Risk, Innovation in Employee Benefits and Business Insurance. You should also know that we have a great team running our virtual program today, but please bear with us should there be any technical difficulties. As you can see, we have 6 great programs for you in this year's series. If you fully attend all 6 events in your CPA, you can earn up to 12 full CPE hours. Last week, as I just mentioned, Jennifer Lewis joined us as our ethics instructor from the AICPA's Business Learning Institute and led the Virginia Ethics program. Today, Marsh McLennan, a new sponsor to the FEF, will present Managing Your Risk, Innovation in Employee Benefits and Business Insurance. Next Thursday, Halloween, the Wells Fargo banking team will present their economic outlook and capital markets update, and hopefully not too scary on that day. Finally, on November 7th, Sage, also a new sponsor to the FEF, will present how AI and digital networks will shape the future of accounting. Before we move forward, I'd like to cover our basic CPE webinar rules. In terms of NASBA compliance, our polling questions will appear throughout the webinar. You will need to answer 75% of the 8 questions to receive full CPE credit for each session. Any answer to a polling question, whether correct or incorrect, counts towards the 75%. Since you'll be muted during this entire session, please use the Q&A feature to submit your questions to the panelists. Also, please use the chat feature to communicate any technical issues that you may have. After the program, please complete the session survey using the link that we will send to you in the post-event email. Your CPE certificates should be issued within 10 days, if not sooner, of this course. If you have any questions, please reach out to Cherry Bekaert Learning at cbhlearning@cbh.com. Now I'd like to acknowledge our great team of sponsors for this entire 2024 Financial Executive Forum series. Our first sponsor is Wells Fargo Bank. Wells Fargo, a well-known national bank, is represented by Ben Kane, their Senior Market Director. Wells Fargo Commercial Banking is a returning and longtime sponsor of the Financial Executive Forum. Our second sponsor is Sage, a leader in finance, HR, and payroll software. Also, Sage's digital network connects SMBs, reduces friction, and delivers insights by digitizing business processes. Sage is a new sponsor this year and is represented by Gary Marr, Senior Channel Executive at Sage. Our third sponsor is Cherry Bekaert, a top 25 nationally ranked accounting firm specializing in tax, audit, outsourced accounting, advisory, and system services, and is represented by Tracy Sheps, a CPA and a partner at Cherry Bekaert. Our fourth sponsor is Cordia Resources by Cherry Bekaert, a leader in recruiting and staffing services in accounting and finance, technology, HR, contracts, and administrative support services, and is represented locally by Doug Smith, one of our key managing directors who leads our sales and staffing service team at Cordia Resources. And our fifth and final sponsor is Marsh McLennan Agency, also a new sponsor this year, and is represented by Ali Gregory, an employee health and benefits consultant. Welcome, Ali, and I'll turn it over to you.
Thank you, Grant. Well, good morning, everyone, and thank you for being with us this morning for our session. To give you a little bit of information about Marsh McLennan Agency, Marsh McLennan Agency, or MMA, as we go by, provides business insurance, employee health and benefits, retirement and wealth, and private client insurance solutions to organizations and individuals seeking limitless possibilities. With over 11,000 colleagues and 200 offices across the United States and Canada, MMA combines the personalized service model of a local consultant with the global resources and expertise of the world's leading professional services firm, Marsh McLennan. MMA's focus is primarily to support middle market clients across all industries and geographies. Our clients share a similar profile to your organizations, and we work closely with many financial executives to support your business goals. We are local to the DMV with offices in Tysons, Rockville, and Hunt Valley, Maryland. Across the Mid-Atlantic, we have over 15 offices and 1,100 colleagues with deep specialization in a range of industries. I'm a consultant, like Grant mentioned, in our employee health and benefits practice, where we work to ensure that our clients have high-quality solutions and sound advice backed by experts ranging from actuaries and underwriters to clinical nurses and health management consultants. And you'll have the opportunity to hear from some of those experts soon. Locally, we are led by Christine Wilson, our benefits division practice leader. We are actively growing our footprint in the greater Washington, D.C. region to enhance our ability to bring innovative solutions to our business community. We look forward to sharing our expertise with you today in our session titled Managing Your Risk, Innovation in Employee Benefits and Business Insurance. On the screen, you will see our agenda for this morning. So we will kick off and I will introduce my colleagues who will be facilitating the conversation. We will start with a conversation around people risk. Then we will take a 5-minute break and we will move into a second conversation around business risk. Grant will come back on at the end to close us out and to answer any questions. So let's meet our facilitators today. I work very closely with both Gerald Escobar and Michael Cooper. Gerald is a vice president and consultant for employee health and benefits. He has over 10 years of experience with Marsh McLennan. He nationally leads our technology and life sciences practice and also specializes in private equity. He lives with his family in Richmond, Virginia, but does a lot of business in the DMV area. Michael Cooper is a consultant on our team. He specializes in government contracting and professional services and has 3 years of experience. I will now introduce Gerald and let him share his screen and start our presentation.
Good morning. Thank you, Allie. Let me share my screen to get started here. As Allie mentioned, we are excited for our first session this morning on managing risk. Before we get started and we introduce our panelists and the topics that we're going to cover, I'm just going to frame up a little bit in terms of what the purpose of this first session is. Specifically, we're going to be talking and discussing about people risk within organizations like yours. When we say people risk, we're really surrounding the topic around what is the most valuable asset within your organization, your employees, your talent, your team members. It's likely every audience member today is covered under a health plan through their employer or their significant other's employer. About 165 million people, or about 60% of those under the age of 65, receive their health benefits as part of their employment offer and participate in those plans. So as you may know, offering health benefits is a core component to being a competitive employer. But as a financial executive and a financial leader, you're also aware that the cost of offering benefits is one of the largest in your budget, and it can be extremely frustrating due to escalating costs and the challenges of healthcare. Right now, the third and the fourth quarter, we're in the middle of the season where approximately 70% of employers are renewing their health benefits for 2025. You may be involved in those conversations with your colleagues, and it can be a conversation that may cause reactive change or trying to figure out how you allocate additional funds to meet the rising costs, or quite frankly, just scratching your head and trying to understand how the math actually works. So hopefully with the right partner and strategy, you can proactively plan on a multi-year approach to meet not only the needs of your employees and their families, but also their health, and bring more predictability to your health plan expense. As you'll see on the screen, today we have three subject matter expert colleagues, part of our employee health and benefits practice here at Marsh McLennan. And we're going to cover three areas that we believe will not only be informative to your planning, but hopefully address some of the opportunities around the challenges that many organizations are facing year to year around their health benefits. With us this morning, in the order of the topics that we are going to cover, we have Peter Schultz. Peter leads our actuarial and underwriting practice at Marsh McLennan. He's a credentialed actuary, a fellow of the Society of Actuaries. He works with his team to support financial leaders to understand the financial risk and reward with the funding mechanism of the health plan. Peter's going to be addressing how the costs are accelerating and the trend increases we are seeing around health benefits. We're also joined by Zach Kornblum. Zach is our pharmacy clinical director. He's spent his career in the pharmacy industry. He holds a doctorate of pharmacy. He helps clients optimize and maximize their pharmacy benefit plan. He's going to be talking to us about the different approaches folks are taking to bend the cost curve around pharmacy, and a timely topic about the increased fiduciary risk and responsibility of plan sponsors, so employers who are offering healthcare, around their pharmacy plan. And for our third topic, we have Kate Follett. Kate is Vice President and Clinical Director for Marsh's Workers Health 360 program. She has a degree in nursing, and also as a registered nurse, she brings the expertise of helping organizations leverage the data available to them through a clinical lens so that they can make decisions looking forward around their employees' risk and health. Kate has worked within large organizations as well as middle market companies and knows the importance of data-driven decisions. Kate's going to share with us where best-in-class employers are deploying new strategies to get a complete view of all their risk, their people risk. So let's begin. Peter, welcome. We're going to start with Peter Schultz. So Peter, you have a national perspective on how employers are dealing with the financial risk and reward of their health plan. If you could, please open up with a few comments in terms of what you're seeing in the landscape from your perspective around escalating costs around medical and health benefits.
Thanks, Gerald. It's a great question, and one that many are struggling with right now. And just a little bit of a backdrop. Recently McKinsey released a study. It's very similar to what we're seeing in the data, and as we look forward to 25 and 26. But trends are projected to be closer to 9 or 10% per year, which is a significant escalation from the levels that we saw just a few years ago. And because of that, employers are looking for solutions, right? They're looking at solutions that they may not have previously considered. And what they're trying to address is the rising cost. And where that cost comes from is many provider contracts are rolling over that were multi-year, that are exiting the COVID period of time when we saw inflation begin. There's some deferred utilization coming back into the system. And then there's also the rise of GLP-1s, additional high-cost specialty medicines, and gene therapy. So all of those factors are really pushing that cost up and are putting pressure on employers to make decisions, to look for strategies that weren't common before. And all of this with the backdrop of the fiduciary liability increases. We've seen suits that have been filed by employees of employers, and they're looking for ways that they can check off all of the boxes, consider every strategy, and mitigate the fiduciary liability risk.
Awesome. Thank you, Peter. So let's dive in here in terms of the funding mechanism. The funding mechanism being either the risk the employer is going to take, or if they're shifting that risk to the insurance company on a health plan. We have employers with us today who may be small organizations, maybe employees under 100 employees in their organization, or larger employers who have maybe several thousand employees. can you share with us on the risk spectrum, the type of funding mechanisms we are seeing across all these organizations?
Absolutely. And I think that to start, right, many of these strategies that we'll talk about today are really enhanced the more experience from your claims that factors into your rates. So as we go down that continuum, the more that those strategies will impact your future premiums. And the continuum that we see is there's fully insured, ACA community rated programs that are out there. There's no experience considered, which makes all of the premium be at a much higher level than if the risk of an individual employer could be considered in the pricing. Then we step towards association health plans, MIWAs, PEOs, so fully insured products, but there's an ability to factor in the actual facts surrounding the employees and the risk of those employees on the health plan in the pricing mechanism. So not changing funding, but changing the way that some of those programs can be underwritten. Then we move on to level funding, which has become extremely common, and it has gone down to, in many markets, 2 employees is enough to have a level funded program. So you'll hear Cigna, United use the term level funding. Aetna uses the term Aetna Funding Advantage. The Blues use the term balance funding in many markets. And that is technically it's a self-funded product, but it has level expenses throughout the year. The health risks are considered in that pricing. So that's kind of the next step. Then we move on to captives. So employers who are self-funded, are not in a level funded product, have some shared risk with other employers in a captive program that's a part of their stop loss premium. And that is kind of the next continuum of risk, all the way down to fully self-funded employers. So they may still maintain stop loss coverage, or some may be large enough to drop stop loss coverage. But that's the continuum. And the further down that continuum, the higher the impact and the more immediate impact these strategies will have. But any employer that is rated based on the health risk of the population, the more risk that the employer takes, the faster those impacts can be seen in the premiums. And go on to the next slide with some strategies. So some strategies that employers are considering, and I'll specifically have Zach and Kate address some of the pharmacy strategies and the clinical strategies that are deployed, but a few of them are alternative networks. So it's something, right? We've all heard of high performance networks. They're out there, but employers are really moving in this direction. So that's one of the top strategies that we're seeing deployed. And about a third of employers have, at a minimum, deployed a high performance or alternative network that has deeper discounts, lower costs with a more limited set of providers. That's the definition of a high performance or alternative network. And about a third of employers have deployed that at least as an option. And another third of employers are considering deploying alternative or high performance network in the next 12 months. And so it is not an uncommon thing anymore. It is becoming a very common practice to look to these networks and these solutions to mitigate health costs going forward. Another strategy that we're seeing become more and more common is direct contracting. There are many employers who are looking to direct contracts with providers in their communities to say, let's take the insurer out of the middle and we're going to go direct, receive a more favorable cost based on the utilization that we can drive to that provider in that market. Another common strategy that we're seeing is health clinics. And I think it's really important to define that as two separate approaches. One, which is the one that many of us think of when we think of clinics, is on-site clinics. On-site clinics are an approach where a large employer with a concentration of membership in an area decides they would like to build out a clinic, hire some providers, and in a sense, drive as much utilization through those providers as possible in order to mitigate the costs that are running through the health plan on a fee-for-service basis. There's other benefits to having an on-site clinic, but that is one of the primary drivers to those large employers deploying on-site clinics. And those clinics are typically causing a significant mitigation in health costs in the markets where they are open for those employers. So a lot of people think of clinics in this sense, but in many geographies, we are now starting to see a rapid rise in shared clinics. And shared clinics are much more accessible for employers that might not have a really large concentration of employees in a particular geography. There are many that there may be 5, 10, 20 shared clinics in a particular geography. And an employer who's smaller, if all of your membership is there, is able to buy into those clinics with other employers. So pool together and deploy the clinic approach when it otherwise might have seemed inaccessible. So that's another approach that we're seeing, and applies to both large and small employers that are priced based on the risk of their population. Lastly, digital health solutions are on the rise. So we think of telemedicine and just accessing care in that way, where you'd have one visit, maybe a little bit of urgent care, but there's much more demand and utilization of utilizing telemedicine as primary care, and also in some cases doing some specialist care as well. So really an expansion of utilizing those services to both mitigate costs where the unit costs are lower than the physical provider offices that we're accustomed to going to, but also the clinics and the digital solutions are really important in some markets where there may be access challenges for employees being able to promptly access care when it's needed in real time. So those are just some of the strategies that employers are considering, and we see a significant rise in them as employers are turning over every stone to try to mitigate the rise of health costs that we're seeing.
Thank you, Peter. So let's address a question from one of the attendees about captives. Can you share a few points on the pros and cons of a captive, as well as the philosophy that sometimes people get into a captive to receive a dividend or a return on their premium? Any comments there, Peter?
Sure. So a captive is some of the pros and cons are, one, and then a captive takes on a portion of the stop loss premium. The captive retains premium and they pay out a portion of high cost claimant risk. So that's, I guess, fundamental to a captive and why employers look to it, because there is an opportunity for a dividend. So should a particular employer or the captive as a whole perform favorably and have a low loss ratio where the claims do not approach the level of premium that was charged, then there's an ability for an employer to receive some of that premium back. So that is one really common reason that employers will look at captives. is the ability to receive some of those premium dollars back to them as that dividend. And that's very much a pro. A con is that captives often require collateral upfront. So there's additional capital that needs to be put up. It's not typically all that significant in terms of the amount relative to the overall stop loss premium, but that's one area. And then the other is, to the extent that the other employers in the captive do not perform favorably, the opportunity for dividends and overall premium increases may go up as well. So it's really important to be in a captive where there's significant strategies and alignment of the employers that are participating, so that the chances of the pool's risk going up do not take away the opportunity for those dividends.
Okay. And while we're on the topic, we have another question. Can you touch on how you define high value care versus high performance networks?
Absolutely. So, and most high performance networks are set up in this way, where the first component that's looked at is, are the providers providing high quality care and following evidence-based medicine? So are they conducting healthcare in a way that's very consistent with the metrics that have been defined? And if first those providers clear that hurdle, then there is a cost component. So after that, providers are then accepting typically a lower reimbursement rate in exchange for members having favorable cost sharing to visit those providers instead of the others in the community. So there is a quality component, but in a high performance or alternative network, typically the quality component is built into the network and goes along with lower cost fee schedules with the providers. Outside of that, if you're not in a high performance network, sometimes it can be challenging to identify the high quality providers and low cost providers. But if you're in a high performance network, a lot of that work has been done for you.
Excellent. Well, Peter, thank you for covering the topic. I think for organizations who are attending today, there's an opportunity to know where you are today and really analyze the available strategies as you've shared on the funding spectrum of what might be the right risk reward calculation for their company. So thank you, Peter. All right, Zach, good morning. Zach,
Good morning, Gerald.
we're going to talk about pharmacy, which anyone who's turned on the TV or sees the news, pharmacy is always out there and aware. People hear things about Ozempic and other new great medicines that are available. Share with us, if you may, just sort of the current state of affairs and where there's some trigger points that are impacting employers around their pharmacy.
Yeah, so of course, pharmacy's been a growing concern for benefit plans for many years. Unfortunately, it's likely to get worse. IQVIA has reported drug spend increasing about 8% a year for the past 5 years, with the expectation that continues into the next 5. The main driver of this growth has been specialty drugs, growing at a rate of more than 13% a year per the CBO. Of course, now GLP-1s are starting to compete with them for that lead position. And then there's cell and gene therapies, which are a new group of specialty drugs with the potential to accelerate specialty drug spend, as they can come with price tags in the millions of dollars. There's currently more than 4,000 ongoing cell and gene therapy trials. And if you were to apply the recent drug trend to the price of milk, we would all be paying like $11 a gallon for our milk.
All right, so Peter, Zach, obviously pharmacy exploding costs, right? One of the things that has become a topic is the fiduciary risk and responsibility of plan sponsors as it pertains to their pharmacy. What are you seeing in terms of strategies and opportunities to not only to lower the costs, but where financial executives need to be aware on some things that are currently happening from a litigation standpoint around pharmacy?
Yeah, so benefit plans looking to gain some control over their pharmacy costs do have several options. In addition to, when you're self-funded, the ability to negotiate your own pharmacy contract. These options are really in the form of some emerging PBM models and what we'll call value add pharmacy programs. So today we'll highlight a couple of the important elements of some of those new PBM models, and we're going to go through 4 of some of those pharmacy programs that we generally see available in the market. So the key element in emerging PBM models is how they choose to be compensated for their services. Traditionally, PBMs are taking a spread on each claim. They're also sharing in the rebates that are yielded by the plan. This sometimes creates some misaligned incentives when highly rebated drugs don't happen to be the lowest net cost option for patients. And I think, Gerald, this is really the driver of some of this fiduciary duty risk. A great example is a drug called Vumerity. It's a brand in a class with a generic alternative used to treat multiple sclerosis. This drug has not actually been proven to be more efficacious than the alternatives. It does reduce side effects, but when you look at those across a large population, the benefit, I would say, is fairly minimal. So not going too deep into the pharmacology, the important thing here is the alternate drug that I'm referring to is Tecfidera, available as a generic called dimethyl fumarate. And the reality is that all of those drugs, when you take them, the body actually converts them into the same active ingredient. The major difference, of course, is cost, with Vumerity being about $80,000 more expensive than the generic on a yearly basis. Despite this, Vumerity has actually gained some significant market share in some of those traditional PBM formularies. When the PBMs choose to be compensated only through administrative fees, these conflicts can be remedied. This is why you've seen, some of the emerging PBMs really embrace biosimilars quickly and use some of the network options like the Mark Cuban pharmacy. Sometimes comparing these approaches apples to apples can be quite complicated. Much of the value from those emerging models is based on changing your drug mix and engaging members into some of these value-added programs. If the programs were to deliver results below an expectation, or maybe there were some pressures working against changing utilization, the financials in these emerging models oftentimes can't compete with the scale of the traditional PBM competitors. So it's important to really understand what member actions are going to be required for these emerging models to be successful. Additionally, your analytics have to go beyond just the PBM contract. You need to understand how formularies are created, what is the expected drug mix of a new formulary or a new PBM, and how those value adds really layer into the big picture. Answering these questions is going to give you clarity into how these different PBM models can be expected to perform. We're currently working with a client CFO on their analytical model. We're actually looking at some of their key pharmacy utilizers. It's like 7 people. We've worked with the HR to understand, who's likely to engage with a program or, let's say, accept a new drug suggestion. And then what do we think the chances of those that engage are successful in each of those layers? From there, we're able to run scenarios and help inform the PBM election and then also the program elections. Another key element to new PBM models is what we'll call navigation. This is also the first value add program to highlight. So this basically just means someone is proactively helping members find the best value drug and pharmacy. Insights are going to be derived from each member's individual data and the plan design they fall under. People are going to be offered suggestions as to which drugs they may want to talk to their doctor about, whether a pharmacy they aren't currently using maybe has a better price for some of their drugs. This is generally done through omni-channel outreach and some technology that makes it possible across a large group of people. In an emerging model, it's likely that this service is a standard part of the offering. For traditional PBMs, there are generally service providers that you can add to the benefit to accomplish the same thing, right? Whether it's owned by the PBM or not, the core functionality of delivering members with access to insights remains the same. The real question is, when you're using it as an add-on, is that PBM sharing the data that's required to deliver truly actionable insights? I think the conversation around fiduciary duty as it picks up, the concept of navigation will come out as a true win-win, right? You're helping both members in the plan save money, and you're doing it through price transparency, which is part of mitigating that potential fiduciary risk. Before we move on to some of the other value add programs, I will say that we've seen a significant uptick in the interest in emerging PBM models, especially after the fiduciary duty questions started to pick up, and to a lesser extent, but still significant, we've actually seen people make the move to some of these PBMs. So the next value add program that I want to highlight,
Just a
and I
reminder,
do see
that question just polling question just went up. Question number 2.
yes. So while we're answering the second polling question, we'll hop into the next value add program, which generally is considered alternate funding. This is really going to be made up of 3 separate alternate ways to buy a drug. So the first 2 come in the form of dollars offered by pharmaceutical companies to offset the cost of their own drugs. This is the copay cards and the prescription assistance programs. Copay cards, very easy for people to enroll in. They work seamlessly behind the scenes when claims are processed, and they allow plan sponsors to capture a few $100 to a few $1,000 a month, depending on the utilizing member. These programs are often called variable copay. They are artificially inflating a member's copay during the claim adjudication, and then they're requesting funding from the pharmaceutical company. The result is you capture the maximum benefit offered by that pharma company. This reduces the gross cost of the drug. Generally, these programs are going to offer members who enroll their drug at no cost share. So again, a win-win for the member and the plan sponsor. The second component, prescription assistance, is a bit more disruptive as it requires people to share tax information. Pharma companies create these programs with qualification criteria based on household size and income. The strategy here is fairly simple. We're just facilitating members applying for these programs. Those that qualify will get the drug at no cost from a mail order pharmacy. Cost to the plan is really the administrative fee for the program, which is typically offered by a third party. Those that don't qualify simply continue to fill through the benefit plan as they otherwise would. The strategy can produce significantly better financial results compared to variable copay. Could be tens to hundreds of thousands of dollars a year, just depending on the drug. The third and final component to alternate funding is international sourcing. We actually see very little of this being used wholesale, but we have seen success in targeted cases. Basically, there's a process for members to complete paperwork as they are personally importing these drugs. The drugs are then sent to them again through the mail from an overseas pharmacy. No qualification criteria, but the drugs generally are paid for in full up front. And it's important to consider whether the quoted price for each drug is less than the estimated loss of rebates, not just the difference in the cost of the claim. The next value add pharmacy program is formulary optimization. So unfortunately, not every single drug provides the value we expect for the cost that we pay. There are plenty of situations where PBMs will include drugs on their formulary really for the amount of rebates they generate, not the actual medical value. Plans can implement drug exclusions and benefit designs that really promote the use of formulary drugs that have proven outcomes and are reasonably priced. Some PBMs are going to offer programs where these so-called low-value drugs are simply removed from their formularies. Additionally, we can actually leverage benefit design within claims adjudication to limit a plan's exposure to high-cost but low-value drugs. And the last program I want to highlight is carved out prior authorizations. Many PBMs own their own specialty pharmacy. They receive compensation from dispensing drugs to your plan members. The source of those compensation is the spread between their buy and sell, sharing the rebates generated by those drugs, and then fees from pharma companies for data sharing and administering clinical programs. These are often the same organizations that we entrust to do utilization management. So there's clear conflict of interest when a PBM is the gatekeeper on their own sources of revenue. Plans can counter this conflict by actually carving out the prior auth to an independent third party that has no financial incentive to make determinations in one way or another. These determinations are always clinically based and not simply denying drugs to generate that.
Great information. So pharmacy is one of the most utilized benefits in the health plan. You've talked about the lack of transparency, the fiduciary risk. What are a few things organizations and financial leaders?
Question 3 is up. I'm sorry to interrupt. Polling question 3 is up.
Zach, as we wrap up pharmacy, you talked about lack of transparency. There's multiple options in the marketplace. It's a large portion of a health spend. What is something an organization can do internally as a question to determine what might be the next best step to tackle their pharmacy?
Yeah, so I really, Gerald, have sort of 2 takeaways here. First, it's really important to understand how your organization views disruption. Right, some organizations don't really even want to ask members to participate in programs, while others have no problem telling people that certain actions are mandatory. So where does your organization fall on that spectrum today? How would that change as pharmacy costs continue to trend? How would that change if you've got a high-cost pharmacy claimant? This is really important. Experience has shown disruption is often the key driver for decision-making in pharmacy benefits. And then the second takeaway is it's important to have an analytical partner that's ready to do a deep dive on utilization in these programs. You should be able to understand for your given drug mix, where are the opportunities to move to truly lower net cost products, and how do you layer in these value add programs into the larger benefit?
Great. Zach, we do have one question from an attendee. Sure. Any comments on Mark Cuban's low-cost drug program?
Yeah, I think the great thing about the Mark Cuban program is he has such a platform that he's really sort of spread the word about some of these challenges. I think a nice litmus test for the PBM is asking them, is Mark Cuban in your network? If the answer is no, can I have him added? I don't think that you can necessarily save a ton of money by shifting all of your drugs over to the Mark Cuban pharmacy. Again, there's some targeted products, especially some of the specialty generics they sell, where there is real, I think, financial opportunity. But the bigger, I think, point here is that it is a good litmus test for, does your PBM have your best interests in mind?
Well, Zach, thank you for that topic. We are going to now introduce Kate Follett. Welcome, Kate.
Good morning.
Kate, we introduced you in terms of the importance of data when financial leaders and HR leaders are thinking about how they can understand their people's risk. Share with us today in terms of what you're seeing in terms of those who have access to data, how they may be leveraging it, and the importance to the planning.
Yeah, thanks, Gerald. As part of our clinical team here at MMA, I bring that clinical analysis into the conversations that our teams are having that are supporting those employers as they're working to manage the employee health risks and, of course, the subsequent costs that are coming with that risk. And specifically our workers' health program that I lead specifically analyzes that medical and pharmacy data that we've been talking about this morning as it integrates with workers' compensation, disability data, and leave data that focuses on that targeted group of the employee health specifically, and how their health impacts multiple areas of the business. Certainly the health plan is a very big cost driver. We want to see what that employee health looks like as that employee works their way through the business in other areas, productivity, right through to leave, right through to workers' compensation. So as a background that might be helpful, between my direct patient care experience, which was about 20 years in hospital settings, and then becoming a consultant, I actually was in a very unique role leading a team of nurses and non-clinical team under a total reward umbrella. And as we managed our leave administration and workers' comp and well-being programs for that large employer, we had been that first point of contact for employees going through a medical event and maybe needing disability or an injured worker who perhaps had to file a work comp claim. So we really learned an awful lot about the behavior of employees and whether or not they were choosing resources that were available to them that we were setting up. And our program's primary purpose was to support those folks going through any type of medical event. And in an effort to be a good steward of that program that I was leading, I had to rely on data to target those high cost areas, and really develop strategies that were mitigating cost and risk while still promoting that optimal health, which was incredibly important. So despite some areas where we had solid data, and I did, I still faced significant challenges in other areas where data just did not exist or was not being aggregated so that we could bring that together to have that holistic picture.
Right. So Kate, you've had a couple different perspectives. Your career has spanned being a clinician. You've also worked inside of an employer and now as a consultant. What are you seeing in terms of best practices? You know, Peter and Zach have talked about the risk reward spectrum, right? So some clients decide that they want to put the risk on the insurance company, but they may get less data. Others are more comfortable with risk reward where they may be getting more data and they can leverage that to their advantages. What are the current innovations and best practices you're seeing that's either going to help not only from a cost perspective, but getting a complete view of their employees' risk?
Yeah, I think that the one thing that I have noticed over the last handful of years in consulting is seeing employers who realize that they've been struggling with some siloed data conversations. In one area, we've got HR working with carriers and consultants to determine what's driving those trends. We've been talking about that today, right? The medical costs, pharmacy costs. Think about your chronic condition prevalence. You know, what does that look like over a span of time? I mentioned having those years of data so that we can look at where those peaks and troughs are and what's driving those costs. Certainly pharmacy costs having a very big impact. Also those complex medical issues that are driving a lot of the high cost claims. And we work very closely with that. And then of course, you've got your ER visits and your inpatient admissions, all of which are really having a very significant presence on that line item for health plan spend. And then separately, we're watching the risk managers who are trying to determine what might be driving those trends in workers' compensation. Are they seeing that increase in injuries and then those costs going up? People who are going out on leave, whereas years ago, if they had injuries, they were just being medically treated. So those costs were a little bit different. Then we see separately having managers who are trying to navigate through one or maybe more of their team members who are absent from work, and then now having to deal with the potential for lost or delayed productivity, which ultimately will impact the business's bottom line. Now, some organizations may have minimal or no data, as we've mentioned, to provide that picture of all or part of their population. So they really have to rely on the intel that they have from the employee-facing teams. And that comes with its own challenges, certainly, especially for those smaller organizations. But it can be beneficial when capturing through the surveys or feedback, because you're still contributing to that larger conversation about what that employee behavior looks like for driving those costs. Now, for those who do have data coming in, one of the strongest strategies that we support that is obviously a big factor of pulling a lot of our financial leaders into these healthcare conversations is the clinical angle that we support to evaluate that high cost claimant group. And as registered nurses on our team, we understand what that treatment cadence will look like and what those costs should be, the associated costs. And that allows us to then work with the carrier's clinical team to ensure those complex medical issues are being managed against best standards of practice, and then interpret the clinical pathway for Peter and his team so that they can help the employer financially plan appropriately or step in if it's needed to be leveraged clinical knowledge as you're negotiating costs. Now, a lot of that in working with carriers, those questions are relative, they're necessary. Having that clinical support from that carrier to come in to sit in and help explain what that cadence is if you don't have support team through your consultants is going to be a benefit. And then sometimes we see internal stakeholders within the organization who are not coming together to share that data set and maybe what strategies or solutions they're putting in place to tackle those problems. What's interesting when we as consultants are gathering these stakeholders together is they often share similar challenges in all of these different subsets within the organization where chronic conditions are coming up and we see them driving costs, whether it's through having people take intermittent leave and they're losing productivity, maybe those lengthy absences, or then having some type of predisposition because of those chronic conditions that are leading to those workplace injuries. And a good example, I think, to share is an employer that we work with.
Question number 4 has been shown on your screen. Polling question 4.
Thank you. One of the employers that we work with is a really good example just to help explain some of the challenge that some employers are recognizing and working towards improving. Several years ago, we had initiated a well-being program that was targeting an increase in employee engagement with a healthcare provider. They had a very high percentage of their employee population who just did not have any claim activity on their health plan. Because of that, we couldn't measure cost, we couldn't measure risk, chronic condition prevalence. We had nothing to go by. So it was sort of this area that was unknown, but we still knew that we needed to help promote having that healthcare provider engagement to make sure that if something was brewing with that person physically, they were able to, or mentally, they were able to have a quick management, evaluation, and diagnosis early on, so that helps control costs. So our client had happened at the time to have an HR lead leave that organization. So the risk manager stepped in that role in the interim. And while sitting in our meeting as we're reviewing the health plan costs, those trends of the health plan that were coming up, that risk manager was learning not only about that increasing percentage of employees that hadn't engaged with a physician, but also the chronic condition prevalence for those who were engaged and showing some claims. And we started to expand that conversation outside the area of just the health plan and asking those questions about whether or not people were coming back to work when they were expected. If they were going out on disability and coming out or going out for 6 to 8 weeks, are they coming back at that time? Or are you starting to see them still being out on leave, 9 to 12 weeks later? So perhaps they had some chronic conditions that could have been delaying recovery time. Were they seeing higher workplace injuries and experiencing higher work comp claims, which may very well indicate those underlying health conditions that pose that risk for somebody as an employee who could potentially be that injured worker, then of course leading to those higher costs on the work comp program. So with the risk manager and the CFO, who he brought in the CFO at that table as well, that HR benefits team all sitting together, we were able to really tap into and starting to have more of these conversations with employers who are just looking beyond that health plan, knowing that, yes, it is a significant impact, but there are similar concerns outside of that one business area where that conversation definitely was having a significant relevance to the impact of that employee health. So over the last handful of years, one of the other strategic approaches that we see a lot of more organizations leaning into is having that C-suite presence, especially CFOs sitting at the table, where we are going through this data and having that CFO who is very much, or any financial leader who is sitting there understanding what those trends are looking like. And as clinical analytics that we are reviewing and sharing what is driving those cost trends, and therefore what the recommendations to be able to mitigate some of those costs make sense a little bit more for them. And they're the ones that are bringing us into that risk management conversation, because we are asking those questions about what's going on in other areas across the organization. Back when I was leading that leave program for employees, our company was pretty progressive at the time, and the initiatives we had in place to support the employee optimal health, it was a very important high-touch service. And our consultants had recommended to us at that time that we implement a digital physical therapy solution due to the increasing trend we had noticed for musculoskeletal issues that we had on our health plan, neck and back injuries. And I had also been noticing that we had a significant percentage of employees who were being injured, filing a work comp claim, who also had injuries to their back, neck, and joints. So as we were all weighing the benefits of putting this program in place, our leadership team posed a question about whether that physical therapy program would reduce the risk for injuries and be able to show that return on investment for both the health plan and the work comp side. Now, at that time, while it was logical that it should, it was just not anything from a data perspective that could be measured, because the data wasn't being captured by the carriers, workers' comp carriers. And what was key, and what we're starting to see many organizations are realizing now, is an important step towards that fiscal responsibility is raising that awareness with the key stakeholders across those business areas, sharing the data when you have it, or the insights, if you don't have the data, that can be helpful to the conversations as all those groups are coming together to mitigate their own risks and costs.
So Kate, thank you for that super important topic. There is one question I think would be great for you to answer from a clinical perspective, and that is, can you talk about engaging employees with chronic conditions without it being a HIPAA violation?
Yes. So on the health plan, when you look from a health plan perspective, we need to, and employers, it's especially tricky for employers, I think, when you have those folks who do have chronic conditions and they're going out on leave. Providing those employees through the leave packet has been my experience, to make sure that you have resources that they can go to, where you're not necessarily jeopardizing the confidentiality, but you're pointing them to the right people who could do that. Typically speaking, that will be the carrier nurse case managers. There's always a resource there through your medical carriers who can help support that. With workers' compensation, a little bit trickier, because you certainly do have people who are injured, and that is not HIPAA protected, yet their underlying chronic conditions are. And that's where the nurse case manager on the work comp carrier side that we work with very closely to make sure that we're not jeopardizing that confidentiality, because it's incredibly important to maintain that. It's a great question.
Thank you, Kate. Well, again, thank you, Peter, Zach, and Kate. We appreciate everyone's time this morning on the topic, and hopefully there's an opportunity to follow up with several of you in another setting. We appreciate it.
Good morning. My name is Michael Cooper. Thank you guys for sticking it out for the second half of our webinar series today. So the first hour, we covered people risk. We are going to be transitioning to business risk for the second part. For us at MMA, that's going to be defined from property and casualty to professional liability, cyber insurance. We're going to be talking a lot about today. But we're excited. We've got a great panel of speakers. We've got a wonderful group of folks here, both from the Mid-Atlantic and then one of them being national as well, one of our directors. So to kind of kick things off, we're going to do some introductions. Once my screen works. There we go. So this is our panel for today. I will be monitoring the chat. I'll be looking at questions as they come up and things of that nature. So if anything happens, I'll be able to speak up and let you guys know once I see the questions for attendance and everything else. But Mike, why don't you go ahead and give some background on who you are, where you're sitting, and then I'll ask Max and Allison and Mario to do the same after that.
Sounds great, Michael. Thank you. Mike Rickard. I'm a senior vice president with Marsh McLennan Agency, and I've been with the company for 18 years. I reside in the Tyson's Corner office.
Awesome. Max.
Yes, Max Richardson. I am an executive vice president for business insurance, headquartered in Charlotte, North Carolina. Little fun fact, so I'm a Texas native, but I'm a proud graduate of the University of Georgia, where I went as a collegiate swimmer. So last weekend's primetime matchup certainly served to be an interesting emotional tidal wave for me last Saturday night. So glad to be here, and thanks for everybody who's in attendance today.
Awesome. Allison.
Good morning. My name is Allison Rossi. I'm a senior vice president. I lead the Mid-Atlantic's executive professional and cyber practice. We are a team of 17 colleagues focused on these areas of insurance. I also serve as our region's regional risk manager, and I've been with the organization, oh my gosh, almost 22 years, and I sit in our Richmond, Virginia office.
Awesome. Thank you. Mario.
Thanks, everyone, for joining. My name is Mario Paez. I'm the National Cyber Risk Leader for MMA, and I've been with the organization for about 5 years. I am a recovering underwriter. I've been on the underwriting side earlier on in my 20-plus year career at a couple of global national insurance companies. And really within our role, we help in making sure that our colleagues are as prepared and have the resiliency in hand when it comes to cybersecurity risk, privacy risk, as well as technology errors and emissions risk as well. I am based in Minneapolis, Minnesota, so please don't hold that against me. I'm actually quite jealous of folks that are a little bit further south than me. So look forward to traveling anywhere around the country, especially during this upcoming winter period. So thanks all.
It's great here today, man. It's awesome. It's not as cold, I promise. Hey, really appreciate you guys hopping on today. We're going to turn things over to Mike, and he's going to kick off our conversation. Max is going to run through a market overview, what we're seeing this year, what we expect for 2025, some things of that nature. And then Allison and Mario are going to give a great cyber presentation. So, we thought it was really important to talk about it today, have them come on, just because the frequency, it's not just the big corporations that are seeing or being hit with cyber attacks, but it's true middle market. And we're really lucky to have them on our team. Once again, I'll be monitoring questions. And yeah, Mike, why don't we go ahead and get started?
Great. Thanks, Michael. I appreciate it. So let's start with some of the things that we hear from our clients on a day-to-day basis. Some of the questions that we hear from our financial clients are, am I getting a good deal? Is my insurance program correct? Are my limits and deductibles appropriate for a company of my size? Do I have the right coverage? And is that coverage, do I have all of the nuances of coverage that are appropriate for a company of my size? What will the renewal look like on an annual basis? And are we in a soft market or are we in a hard market? These are just some of the questions that we hear from our clients. Mike, if you could, next slide. So Marsh McLennan Agency is the middle market arm of our global brokerage parent company, Marsh. Our parent company is the largest broker in the world. It's in over 130 countries. We have 85,000 employees globally, 23 billion in annual revenue, and we're a Fortune 250 company. But what does that really mean to clients and financial executives like yourselves in the middle market space? Mike, if you could, next slide. We believe that Marsh brings real value with our middle market agency, Marsh McLennan Agency. All of the resources that are available to our colleagues at Marsh are available to the colleagues in MMA to deliver to clients like yourselves. Our parent company delivers best-in-class consulting and brokerage to companies in the Fortune 500, and we deliver all of those same resources to companies outside of the Fortune 500. What's important for you to know is that we're completely integrated. We have access to all the same resources. And what that does is that changes the paradigm of expectations and service level for companies in the middle market space. Next slide. We call this the strategic brokerage model, and it allows us to deliver unique value that provides answers to questions from slide 1. Things like global premium leverage that drives cost savings for clients, proprietary products that provide custom coverage and pricing advantages to our clients, packaged solutions that solve client issues. And when you're working with a large number of clients like MMA and Marsh, we have data, and our clients have access to that data, which can provide guidance on pricing, deductible levels, and limits for companies of all sizes. Next slide. So we don't have enough time to cover all of these today, but my colleagues Max, Allison, and Mario will share some of these resources today. And as Mike stated, Max will start with our State of the Market report, and then Allison and Mario will then follow with our cyber solutions and coverage.
Yeah, thanks, Mike. And I think that frames up the conversation well, right? Like talking about Marsh and how we're integrated with them, but still in the middle market, and we get access to some of the things we're going to be talking about today and what our benefits team was talking about earlier. So that being said, Max, I'll kick it over to you.
Thanks, Michael. Much appreciated.
And there's the first question slide.
I see a first question here.
All right, Max, I think you're good.
Okay, perfect.
Yeah.
Well, again, thanks everybody for having us here, and Mike, thanks for doing a nice kind of overview of Marsh McLennan Agency and how we integrate with our parent company Marsh. I'll give a few just kind of musings and observations on what we're seeing in the current insurance marketplace, and largely what I would say, given the group of professionals that we've got on this call and in this session, it's not a lot that you haven't heard or haven't seen as you read various publications, whether they be specific to your industry, specific to the economy, things in the Wall Street Journal, and everything in that regard. What this slide shows here is just kind of what we've seen, generalized insurance market pricing really since Q2 or second quarter of 2020. And this graph does have a very nice downward trend, but what I would say is what it's really telling us is not that insurance pricing is necessarily coming down. It's just that the increases year on year, quarter on quarter, are trending in the right direction, more towards a flattening. And so we had expected this year, and we're seeing much of it being a market in transition from something that was a hard market where prices were continually going up and up and up to something approaching either a flat or a soft market, depending upon a few things. So, Michael, if you'll go to the next slide, I'll let Mario and Allison hit on the right-hand side of this slide when they go through their part of the presentation, which is arguably much more exciting than what I'm talking about, given current events and claims scenarios that we've seen in 2024. But in general, the property and casualty sectors have trended a little bit different, and they've trended a little bit different for different reasons. So property, due to a number of different items, really over the past few years have been driven by secondary perils. And that's kind of a new term, if you will. Everybody is familiar with hurricanes and earthquakes and wildfires. But where we have seen a enormous increase in losses has really been in what are termed as convective storms. Those big, really nice, healthy thunderstorms that you get, especially in the Southeast and through the western part of the kind of Southwest. During the summertime, we've seen those pop up actually in the Midwest, which has been a little bit surprising. Some freezing, some ice storms in places that we don't normally get those, and the outsized effect that they've had on the property market has been tremendous. So all weather related for the most part. Casualty, while it's remained relatively flat, the increased pressure that we've seen specifically in the U.S. Has largely been due to litigation trends, and what we would really term these days is some litigation abuse. More to come on that. We've got a white paper that we're kind of authoring right now to come out in a couple of weeks. So we'll make sure that this group receives that as a follow-up to today's session. Go ahead, Michael. So the data and the specifics here that I'm talking about really were prior to Hurricanes Helene and Milton coming through, and they continue to be true. So what was very evident over the past few years of storms was not only on the lack of what I would say is integrity on value of structures, whether it be commercial or residential in catastrophe-prone areas. What was even more impacted, to use a word, would be how much business interruption expense was associated when you did have a structure that was damaged or completely wiped out. This, of course, was piled on with what we saw through the pandemic and kind of that hangover effect with the pandemic, fragile supply chains, and the ability to get buildings that were either partially or fully damaged back to where they needed to be to allow the business to get back up and running and mitigate some of that business interruption expense. Little small commercial for Marsh and for MMA. We did roll out a little earlier this year a supply chain mapping technology piece, software piece called Centric. And Centrist actually gives the ability for business owners not only to understand where their first level supply chain issues might come from, but the supply chain behind the supply chain behind the supply chain. So it's not always just the pieces and parts that the businesses need to buy. It's the manufacturers who supply those pieces and parts that need to buy, and then all the way back to the resources that are needed to produce those pieces and parts that the customers need to buy to get them back whole and operating again. So go ahead and go on to casualty there, Michael. What you'll see here is that auto and umbrella are closely tied together in this regard. General liability also subject to quite a bit of litigation expense and litigation trend. Workers' compensation has remained generally healthy, but there are some expected issues that we think we might start to see pop up in the next 18 to 24 months, going into late 25, being kind of the earliest with mid-year 26. Some of that is just a bleed over of litigation inflation around workers' compensation claims. Where we're seeing it hit us right in the face right now is really around auto, which drives up into the umbrella or the excess liability coverages, just due to the size of the verdicts that are out of there and coming out of there. So there's just a lot of pain and a lot of pressure due to that litigation abuse, some of which is being fueled over the past few years by private equity entering the litigation space and effectively funding this activity, but albeit kind of in the shadows or behind the scenes. Go ahead, Michael. Aviation, relatively healthy market, the trending in line with general inflation of what we've seen over the past few years. But the supply chain hurdles certainly are having an outsized effect on claims costs. Within environmental, capacity and capital is still very sufficient in this space. These are long tail and long duration risks, so it takes quite a long time to understand what the results truly look like. What I would say is, and this is not a political statement at all, however, we do have an election coming up in not so many days, and depending upon the tact that the administration takes around continued effect on regulations, will start to drive where this market goes over the coming years. International, again, remains very, very stable. It's a very healthy space within the overall ecosystem of insurance worldwide. However, specific kind of risk and geographic elements are really driving the results in what our clients are seeing and feeling there, whether it's a risk that's based in somewhere like the Middle East, Russia, Ukraine, or if it's very specific in something like aviation, shipping, for instance, where there's an outsized effect on the results there. So go ahead, Michael. On to surety, a very U.S. centric type of a product because of the Miller Act. What we've seen in surety is that there's plenty of capacity, quite a number of players, probably more than there need to be at this point, but there's a lot of capacity chasing the surety bond business. But I'd say the overall posture of the industry has some nervousness around it, just because of overall balance sheet health of the construction community, and that's really being pushed by workloads and work programs that are at their all-time highs. Projects are becoming larger and more complex, which equals a larger time duration. And then when you throw on top of there the risk that has, it puts even more pressure on the cash that contractors need to maintain their business as projects become longer due to the complexity and the risk associated. Go ahead, Michael. One thing where we have seen, now we got a question again.
Yeah, if everyone has the question, or maybe needs to minimize their screen so they can see it, the new question's up. And Max, you can keep going.
Okay, perfect. One thing that we have seen through the first half of 2024, it's been buried in quite a few headlines in spots, but bankruptcies are on the rise, kind of not really hitting any one sector or any one spot. Retail, of course, is always very, very sensitive to bankruptcy. along with other things that involve any type of free cash flow or disposable income, hospitality, and things like that. So we have seen quite an uptick in the bankruptcy space, and there has been an increased focus in that space around trade credit insurance, which is a little bit new. It might be a newer term, but we are certainly spending a continued amount of time on trade credit insurance. A lot of capacity chasing it, so a lot of competition in the market, and it's keeping everything very healthy for those customers that are exploring it at the moment. If we move on to workplace violence, this is something that I think everybody has got some sensitivity around. There is kind of a hypersensitivity within the greater all culture, whether it's in the US or worldwide. And California, as of July 1st of this year, was the first to enact some pretty stringent requirements around employers to have workplace violence prevention plans in place. And we would expect some of that to continue to migrate in an easterly direction, as a lot of legal trends do coming out of California. It's certainly a very important risk. One of the things you want to consider, when you have regulation comes into place, it certainly creates quite a bit of work, and we've been doing quite a bit of work with all of our clients that have got California employer exposure, even if they're not headquartered in California. If they've got locations or employees in California, they're still subject to the Senate Bill 553 that was put into place. So, Michael, if you want to go to the last slide, I think I would just say what we have seen in general, especially with regards to the last couple of storms that have gone through, Helene and Milton, along with the workplace violence, the trade credit insurance, and a few other things. We're just seeing clients take a much more healthy and holistic view of what are all the risks to our business, where have we traditionally used insurance to protect us from those risks, hopefully at the right price, the right cost, the right amount of limits. What do we do with these new emerging risks that are coming at us? How do we handle it? How do we handle it appropriately? And with that, I will hand it over to some of those more emerging risks that are coming at us, whether it's in the financial lines or in the cyber world, to Mario and Allison.
Yeah, Max. Hey, two quick questions before we move on.
Sure.
One, this was from the audience members. What do you think is causing the fragile supply chains, and how is that affecting our clients?
I think businesses at large have become a lot smarter over time and have adopted a much more lean approach, especially when you think of inventories. And so when you have things that go into effect, right, wrong, or indifferent, the U.S. government pushed very hard in the way of EVs, electric vehicles. And, so we saw that effect on the construction industry, from the standpoint that much of the resources, whether natural resources or manufacturing resources, were shifted to supply things for the EV sector of the auto industry. It pulled away from the traditional electrical contracting space in the construction industry. So, you had delays on construction projects of all sorts, truly due to just a shift in direction, where it just puts a strain in spots that haven't traditionally had that strain before.
Yeah. And then real quick, so we can give Allison and Mario a full 30 here, could you define and what compromises or comprises a workplace violence plan?
So from a workplace violence standpoint, it's really more of mapping out your operations as a company and what could possibly happen. A lot of people think of active shooters. A lot of people think of what if one employee just is disgruntled with another employee, and how to handle those things. One thing we've observed is in developing those plans, there does not need to be a whole lot of ambiguity or decision making when a workplace violence item occurs. There needs to be a very, very structured, almost a military chain of command to de-escalate the situation, handle it, bring the appropriate resources, and minimize it immediately. So it's a step-by-step flow chart that you pull yourself through, and we can help with that on developing that plan should something unfortunate occur in a client's organization.
Gotcha. Awesome. Well, thank you, Max. Much appreciated. Allison, Mario, I'll turn it over to you guys, and I will drive slides again for the cyber liability kind of update landscape and all the good stuff there.
Thanks so much, Michael. I appreciate it. Well, thank you everyone for allowing us the opportunity to address this audience this morning. I thought what we would do is just briefly go over the objectives that Mario and I have for the next 30 minutes of your time. We really wanted to keep this high level. It's a challenging topic to do that for, just because it is so intricate and there's so many moving parts to this space. But what we hope to achieve here is really provide you with a high-level overview of key themes relative to cyber risk overall. High-level knowledge relative to the insurance market, risks, exposures that we see, and ways to, in fact, transfer the risk to insurance and mitigate it from an organizational perspective. We'll provide an overview of recent events and loss amounts that I think will be very interesting and eye-opening. We'll delve into the coverage provided by a cyber liability insurance policy and the different sections of that contract and how the risk, in fact, can be transferred. We're going to kind of end with showing you and discussing best practices for mitigating these risks, as well as some of the resources we have built at Marsh & McLennan Agency.
Awesome.
Michael, next slide. Thank you. And you can keep going one more.
Yeah.
So I think it would be important to just give a little bit of a history lesson here and look back at the trajectory of the market over the past decade. And I'm dating myself a little bit because I've been involved in cyber since it really kind of started in the late 90s. But, you know, for the majority of the product, it really was a very soft insurance market. It's still considered a newer market. And so it's a segment that sees frequent changes and therefore reacts to developments in the market very quickly and faster than other lines of coverage. In 2020, that was really the first hard market that we saw in cyber. And that was really due to, you know, the emergence of a global pandemic and businesses working remotely on a global scale. I think many organizations at that time learned that they did not have the sophisticated cyber hygiene. And in many small to mid-sized businesses, controls were less than desirable, and criminals really took advantage of that posture, if you will. And so the next 2 years for us as brokers really were focused on navigating a very challenging insurance market, and more importantly, finding ways to support our clients in their journey to hopefully find ways to mitigate the risk. You know, in 2021, our insurers were really adjusting for a lot of the exposure that they weren't really able to properly underwrite for, since it was such a new product. And so there were consistent premium increases. The pricing was getting really, really very steep. In 2022, things really stabilized. We were finding that clients really heard the message. They were able to get better controls in place. And as a result, the market has really been stabilized since 2022. Michael, next slide. So if you want to really take a look at, you know, the overall market, you know, I think we break it down in 3 different ways. You know, what is the claims and risk environment? What are pricing and purchasing trends? And what are underwriters really focused on? In the claims and risk environment, the concern is still an aggregation exposure. And so we'll get into that a little bit more later. But basically, what that means is, do we have a lot of organizations that are relying on the same software or the same cloud providers, where one vulnerability in a key piece of software, or if a cloud provider goes down, from a downstream effect, basically hits and impacts many different organizations. With ransomware, we still saw a significant increase in those events in 2023. The threat actors were really continuing to deploy different tactics and more sophisticated methods. And so when we talk to our clients about mitigation and making sure that controls are where they need to be, it's not okay, I have MFA, multi-factor authentication in place and I'm done. It's a constant evolution of making controls more pristine and making sure that our clients are keeping up with the threat environment as it continues to evolve. Historically, ransomware really only involved the encryption of data so that the organization would be unable to operate. More recently, what we're seeing is that they're actually exfiltrating the data and threatening to publish it. And that really then transfers into more of an organizational reputational event and risk. From a pricing and purchasing standpoint, as I've said, the rates really have been stabilizing, and our clients have utilized that as an opportunity to increase their limits or take down their self-insured retentions. From a coverage and underwriting standpoint, these forms are very intricate. So they're not off-the-shelf products in that if you look at a Chubb policy versus an AIG policy, they're going to be exactly the same. It couldn't be further from the truth. That's why it really takes a specialty broker to get involved and negotiate the proper coverage. The underwriters are having a lot of variation in how they approach the war exclusion, and that's certainly because of the rise of geopolitical tensions, which we continue to see. Another area that's been challenging is our evolving privacy landscape. We have a patchwork approach of privacy legislation here in the United States, so the underwriters are focused there as well. So there is the concern that you might see wrongful collection exclusions or exclusions related to biometric information or website pixel tracking. Michael, next slide.
Hey, Allison, quick question. And if you're going to cover it later, that's totally fine. But, some people may not have seen some of the flatness or price stability as you're talking about, I'm assuming resources, and what are some things that they could be looking at to kind of negotiate strengths that they might have for those renewals?
Yeah, so it's really important, and this is actually the last point on the slide. So Michael, thank you for the reminder. You want to make sure that you're demonstrating to your insurers the improvements that you've made in your cybersecurity program over the past 12 months. So even if you're completing an application for these coverages, maybe a question doesn't exactly get to the heart of the matter of what your organization is focused on, make sure to include a summary of that, because that's going to be really important when it comes to negotiating the best rate possible and the most comprehensive coverage. A robust and well-organized submission is so important, and that's definitely something that your broker should be working with you on.
Cool. Thank you, Allison.
Yeah, of course. Yeah, so this, let me just
quick question. For those,
question.
Managing your risk, please, are you still participating? Reminder to minimize anything else so you may miss the pop-up, and Allison, you can keep going.
Yeah, of course. So this certainly paints a positive picture, right? When we look at the competitive rate trend that we're continuing to see through August, low single-digit decreases are still being experienced at both the primary price per million as well as the total program price per million. Again, clients are more than likely to utilize this savings to secure higher limits or to reduce their current retention. We also have several tools here at Marsh that we can utilize to help our clients with benchmarking, meaning I want to look at a peer group that's similar to me, the industry that I'm in, the revenue band that I'm in, if I'm a publicly traded company, what my market capitalization is, to understand how are other companies purchasing? Are they purchasing more limit? What is their pricing? But also looking at modeling and analytics where we can input certain scenarios to understand what a client's cost of risk would look like in comparison to the total limits that they purchase. I think, to wrap up this slide, the question that is really on everyone's minds right now is, will this pricing, the stabilization hold? or will we really go back or revert back to what we saw, you know, in 2020 through 2022? I think what we don't have a crystal ball, but certainly what we think is that most organizations went through enough of a correction in terms of cyber hygiene that we hopefully wouldn't revert back to what became almost triple-digit increases during that time frame. Michael, next slide. So getting into the risk environment a little bit more, and I kind of already alluded to a couple of these things, but catastrophic risk has been a growing concern for insurers as technology advances and interconnectivity with organizations increases. So when we talk about aggregation exposure, what we really mean is a single event that impacts more than one company. It could be an exploitation of a common vulnerability in a piece of hardware or software. We saw that with the SolarWinds situation. It could be a common dependency on a cloud provider. That cloud provider then has an incident and organizations are no longer able to operate. You know, I mentioned geopolitical tensions. I mean, that certainly has you know, folks concerned about the war exclusion in these forms and how they want to craft that language. I think it was just this week in the news that we saw that the state of Georgia warded off a cyber attack in regards to their election systems. And certainly I think with the election only, I think 12 days away now, that's something else that we're concerned for. You know, also our insurance companies have pressure from their reinsurers. And their reinsurers, understanding that everything that's going on the global scale, they want to make sure that the language in those forms pertinent to the most significant risks is as tight as it needs to be. So we're very watchful of that. You know, I alluded to privacy regulations. This is a real concern for organizations because the way that we share and collect information just increases. And because we lack a singular comprehensive data privacy law in the United States, it makes it more challenging for our clients to make sure that from a compliance standpoint, they're adhering to all of the requirements of these different privacy regulations. Non-compliance can also result in significant fines and penalties. For example, our Virginia Consumer Data Protection Act carries fines of up to $7,500 per violation. These laws also allow for private rights of action. So it's really important for organizations to take additional compliance steps and to really do an inventory of all the jurisdictions in which they're doing business and where they have this data. You know, the cyber incident evolution, you know, we're focused very much on data compromise and business interruption because this is so impactful for organizations. You know, I think everyone's really curious about ransomware. A lot of times the question that we get from our clients is, well, what does the policy say? Am I required to pay the ransomware? These forms do not predicate coverage on you having to pay or having not to pay the ransomware. But it really is a philosophical discussion that you need to, you know, come to terms with in your own organization. As of late, more organizations are choosing not to pay the ransom, and most of that insurance limit is in fact going to the business interruption insuring agreement, which gets contemplated as a result of that ransomware. And I think the reason for that is more organizations are prepared. They've gone through those years of really putting the budget into getting their cybersecurity hygiene where it needs to go, and embarking with tabletop exercises and things of that nature. Michael, next slide.
Yeah. And hey, we just had a quick question come in. We will be sharing
Okay.
information and slides after this. Someone wanted to connect, so just FYI for all the attendees. And we've still got about 10 more minutes or 11.
Yeah, I need to really speed it up here so Mario has time. So let me just hit this really quick. I think this is really significant for all of you on the phone. You know, in 2023, in July of 23, the Securities and Exchange Commission adopted the final cybersecurity disclosure rules. Now, this is applicable to publicly traded companies, but in a way, it really has, you know, a downstream effect to all organizations to kind of understand how much scrutiny there is and to make sure that the management has a role and the board has a role in containing, you know, cyber across the organization. So there are really two parts to this. The first is a material cybersecurity incident reporting, and that publicly traded organizations must report within 4 business days of determining event material, because they want their investors to understand, is there something bigger going on in the organization, you know, that could affect operations, finances, brand perception. And so it's not just the immediate fallout. What's a little challenging for organizations is the SEC doesn't define materiality. So there has to be a way for the organization to find a reasonable approach to attack what is material and what isn't. The second thing is really a cyber risk management strategy and governance disclosures. Publicly traded companies now have to report on processes for assessing, identifying, and managing material cybersecurity risks. And even publicly traded companies that tend to be very sophisticated are not necessarily prepared for all of these requirements.
Awesome.
Next slide. Yeah, so just really briefly, a lot of organizations are continuing to rely on third-party technologies, vendors in the tech space and the operations space. So a lot of risk comes into this, where those third parties have access to an organization's data. And so we really recommend that our clients do an inventory of their third-party vendors, prioritizing those that are critical for business, both from an operations and a technology standpoint. Review their third-party vendor risk management program to understand the roles and responsibilities, as well as the indemnification clauses in the contracts. And they want to understand how their vendors are treating data and what their overall cyber posture as well. And before I hand it over to Mario, I think this is a really key takeaway. Michael, next slide. That still 75% of business leaders consider cybersecurity to be one of their top concerns. So this is not something that's going to go away. It's going to continue to evolve, and we have to stay on top of it. Mario, I'll turn it over to you.
Yeah, thanks, Allison. And in the interest of time, I'm going to go through this pretty quickly here with some of these breach stats, if you will. And again, these will be shared. The slides will be shared after the presentation. So I'm not going to touch on them as much. I think Allison already hit on a lot of good points here in relation to ransomware and breach response expenses as well. I mean, we are seeing this tick up from a breach response perspective, averaging $1 million. From an organizational standpoint, I know there's a lot of diversity of organizations and industry and size of organizations on this line here. So we respect where every organization is at. I think, but to one of Allison's last comments surrounding the interconnectedness of all organizations, no organization itself is immune itself. But you see the tremendous connectedness with other organizations and dependencies on other organizations. Hopefully, for many organizations following even just the basic headlines, especially when I hear it from my wife that says, oh, I heard of this new incident in the news, who's not in insurance and risk management. It's pretty telling. And I think that's where you look at, from a CrowdStrike, Kaseya, Blackbaud, SolarWinds, Change Healthcare, CDK, every industry is being impacted here. And the point takeaway here when it goes to looking at these stats is that $1 million may seem quite large, or it may be quite small, depending on where your organization is ranking, right? But I think when we look at cyber insurance as an optional to transfer some of that risk, and looking at that as a mini incident response plan in and of itself, it's part and parcel of a comprehensive cyber risk management program. It's not a one or the other. So I'm going to continue to move forward here. I do have some slides on some best practices that I really want to touch on before we close up. So moving on to the next slide, looking at the extortion events. This is good as well, speaking to the better hygiene. In the interest of time, I'm going to keep moving forward here, Mike. So thanks for kind of going quickly through these slides. A lot of background as to why we saw a little dip in 2022 with extortion, but it's on the uprise. Some of this has to do with geopolitical tensions and the Russia-Ukraine war as well. But now we're just seeing ransomware continue to be used. And I could see this 2024 period as near an all-time high for ransomware events, unfortunately, even though perhaps they're not as prolific in the media. We certainly are seeing the volume in relation to the record year of 2023. Okay, and into the next slide. Oh, I see that there's another
last question, it looks like. So if you're on, paying attention to the last question, make sure to minimize screens and hopefully see it. Mario, keep going.
Perfect. So yes, this is a positive trend. Allison alluded to it as well. Less organizations are paying their ransom demands, which is great. We don't want to continue to fuel the fire here and reduce the opportunity to demonetize infiltration within supply chains or organizations themselves. So, all right, I'm going to go very quickly again through these next few slides. The big takeaway is there's just kind of 101 this here, two primary buckets of cybersecurity coverage. First bucket is first-party expenses. You can see breach response expenses to help organizations respond, investigate, understand the scope of a suspected cybersecurity failure, privacy incident, or a system failure. There may be an unplanned outage, something within the supply chain that goes down. We're not exactly sure if this is malicious or non-malicious, such as the CrowdStrike matter. That investigation cost is a key element of the first party bucket. Bringing that forward into the cyber extortion, obviously the cost to provide the ransom payment is also included in here in most comprehensive policies, but understanding you are not forced to pay the ransom demand. I know sometimes that's a question we get from organizations. It's a consensual discussion to see if it's in the best interest of organizations to pay that ransom payment, but ensuring that you have forensics and legal guidance in making that determination is tantamount. We've seen some things go off rails if we're simply trying to get our systems restored without ensuring that the threat actor has been removed. And now we're really in a delicate situation where if we're paying an OFAC sanctioned entity or criminal ring, that could be, now we could be in trouble with the Department of Treasury as well. So again, just that due diligence and incorporated into this first party coverage is key. Business income, extra expense. I know Allison alluded to this as well. Very important piece here that I'll reference is contingent business interruption. Contingent business interruption that's connected to a security failure and a system failure. System failure as an unintentional, unplanned outage. That again, given the connectivity all organizations have with IT and non-IT service providers to your supply chain, that is a critical piece to make sure that we have that as robust as possible and at the highest limits possible as well. And then data asset protection, data recovery is another key element here. Just in the interest of time, I'm going to speak forward here onto the second bucket. This really covers the defense indemnification expenses that may ensue after an incident has occurred. Not to mention there's privacy, regulatory fines and penalties coverage, media liability stemming from copyright, trademark infringement, invasion of privacy type claims as well. So I'll keep moving forward here. Two quick items: social engineering fraud, fraudulent instruction. We see this just rampant invoice manipulation. This is more of that financial crime, the cyber crime piece where we're trying to actually have or coerce transfer of funds that can be in manipulating an invoice. We see this every day and it's alarming. Sometimes it goes in multiple payments where controllers or folks within organizations, even junior level finance individuals, professionals are coerced into sending that. So again, I have to imagine that this is not first time folks are familiar with this. This is just where we have to step up our guard and training within finance teams, all teams, to be quite honest, to help identify and manipulate this type of social engineering fraud from occurring. All right, moving even quicker here. Our top cybersecurity controls, Mike, if you can move a couple slides forward here. Again, this will be a good takeaway. These are our top 12 cybersecurity controls that we strongly recommend organizations consider. What's top of mind right now? I mean, some of these are very basic controls that have been in place, part of cybersecurity frameworks for a number of years. But this is what the cybersecurity insurance community is really going to hone in on. What's the most popular right now or around vendor and digital supply chain risk in the bottom right corner, patch management and vulnerability management, privileged access management or identity access management is key. So you're connecting all of the various partners together. What types of controls? Do you have a multi-factor authentication? And then a broader overarching theme is zero trust architecture, ZTA. And that's something that is for a different session as we move forward. All right, I know I need to wrap up here shortly. Couple slides, just takeaways. You can look at them at your leisure. Just some tips in building out a mock simulation or a tabletop exercise, some best practices to deploy Next slide just speaks to a sample incident response cheat sheet, if you will. So recommend this, incorporating that. Final slide here before I hand it back over to Mike and team is our cyber resiliency network. If you have questions as to, hey, what's zero trust architecture? What's identity access management? Can you help us with that? Yes, we have some internal colleagues that can help on that, as well as our cyber resiliency network that can help in providing complimentary and discounted services to help reduce that barrier to access vetted cybersecurity and privacy legal experts. There's a lot of noise out there. This can help in reducing some of that. So I'll take a breath here and pause, but hand it back to you, Mike, and team, as we wrap up.
Great. That was awesome. Really appreciate it. And I think, takeaways, we're here to help. The teams we're local, and Mario zooming in from Minneapolis, much appreciated. But yeah, really appreciate everyone's time and questions and comments today. We will be sending out the slides. We'll figure out contact information. Allie has dropped my email and hers in the chat, so feel free to just ping one of us too, and we might be able to connect dots a little bit sooner. And we'll get the slides out shortly. But Grant, with that, I'll let you take it away, man.
All right, Mike. Hey, I appreciate it. What a great program today, guys. Really interesting, full of just great information for everyone in the FEF group. Just really appreciate, Allie, Mike, Gerald, and team all participating today. And we really appreciate everyone who attended this morning. Another great day, full attendance. I'd also like to thank our exceptional marketing support team at Cherry Beckert, including Amanda Kiefer, Maddie Robbins, Leah Gearhart, Ziba Farha, Kate Dharma, and Eunice Arias for preparing and running today's event. Our next event is always a fan favorite and will be presented by the Wells Fargo banking team, whose senior economist Tim Quinlan will provide their economic outlook and capital markets updates. So that's next Thursday, Halloween, October 31st. So finally, I'd like to thank all of our sponsors for their support of the FEF series this year, and especially Marsh McLennan for just the awesome program that you guys put on today. We really appreciate it. So until next week, thanks everyone, and we look forward to seeing you next Thursday morning.